Hi, everyone. Thank you for coming to our panel. There's more people here than there, so maybe I'll do it like this. My name is Marina, and I'm leading the European Crypto Initiative, which is a non-profit association based in Brussels. And for the last 4 years, we have been in the MiCA negotiations, anti-money laundering, and other rules that have been finalized within the European Commission first drafts. And I'm really, really happy to be able to moderate this panel today with my guests. And I will start with, just calling your name, but I would like to ask you to introduce yourself. I think you would do that best. And maybe we can start with Xavier.
Yes, hello everyone. So my name is Xavier Lavayssiere, and I've been mostly working with the public sector, with the public institutions that are looking into the space and trying to see what they should do toward this. And as we briefly discussed before, maybe as a starting point is like, they have been hesitating for the last years if they should regulate it, if they should forbid it at all, and if they should create their own infrastructure. So I think that's part of the problems I've been helping them to think about.
Eli?
Yeah, thank you very much. So my name is Eli Cohen, or Eli Cohen in Brussels, as you wish. So I'm the general counsel at Centrifuge. Centrifuge is a tokenization, securitization platform. It's an open source protocol that allows issuers to create their own pools of tokenized assets. And we have launched originally 2020 with our first pools opening in 2021, about 290 million right now TVL. So it's one of the oldest sort of tokenization platforms, which I'll talk more about later, I'm sure.
Thank you very much. And Jon?
Yeah, hi, I'm Jon Egilsson. I'm co-founder of Monerium. Monerium is the company that was the first to get a license to issue e-money tokens in Europe. We got that before MiCA was a thing. And more than a year ago, we integrated our solutions with the SEPA system. So our customers basically get Web3 IBANs, so you can go in and out of Web3 as you wish and connect it to the infinite liquidity of the banking system.
Great. So before we start, I have questions for you. If you might help us set the tone so we know we don't bother you with the discussion. How many of you are from Europe? Can you raise your hands? Great. How many of you have read MiCA in a part that regulates stablecoins? Okay. Wow, amazing. Okay, we can go into pretty deep discussions. So for those who haven't read that part, I think it's very important to know that in a way MiCA does regulate the issuance of stablecoins. We do have two different types, the e-money tokens and asset reference tokens. But what is also interesting in MiCA is that it has one specific part that says that decentralized projects might be excluded from MiCA. So this is just to set the tone, but I would give the floor to Jon. So Jon is working on a stablecoin for a really, really long time. They were compliant under the e-money regulation. That was something that existed, directive before MiCA. And how did MiCA change your situation, or what it brought? What is the difference between what existed before?
Yeah, for us, then, as Mariana said, we got the e-money license to issue e-money tokens. And it means that there's a lot of concerns for consumer protection, like how you safeguard the underlying assets. For example, you have to have it in segregated accounts, the way, in what assets are you allowed to safeguard it on behalf of the customer. And you have to, issue and redeem at par and so on. So we got this license in 2019 after consulting with various jurisdictions in Europe. But what MiCA does is basically saying, well, if you want to issue fiat on chain, you have to be an e-money issuer, and your system, your platform just has to comply and support that. And then MiCA says some other things, adding some additional requirements. But the core of MiCA for e-money tokens is that you have to be an e-money issuer. So how much did it change? Not really much. Some people complain that there's a lot of,
it's a burden. You have to comply. It takes, you have to have resources.
You have to have extra, you have to have your own equity in addition to backing the stablecoin, if you will, or e-money token, 100%, you need more. You have to be audited by, you're regulated on a regular basis. You have to comply with KYC. You have to comply with AML and all of those things. It's a lot of work, but we thought, inevitably, everyone needs to be compliant if they wanted to issue fiat on chain. Because in my mind, and my co-founders then, fiat has always been and will probably always be a legal thing, and if you want to basically service this market, then it's important that you have just regular money, like the euro. It has to be regulated in a similar way. It's called the singleness of money. It doesn't matter if your euro is on a mobile wallet or a debit card or a token, it's just the euro. And that is our philosophy from the very beginning. It's just the euro. We don't like the term stablecoin. We just use the term fiat on chain. So it hasn't changed that much, but I could also go into, if you like, the later stage, the additions that I think we should work on going forward.
Thank you so much. Xavier, do you have any comments on that? And maybe specifically of what do we see MiCA brought? So as you know, end of June, MiCA became applicable in this part of stablecoins. So what have we seen online of, what were the reactions, but also how the community reacted, and maybe a comment from your side, what do you think MiCA brought? Is it useful? Are you critical at certain points? Or what's your opinion in general on that?
So I'm not sure I can talk about how all the community reacts, and what we can see only is the fact that there is a high barrier to entry for getting all this compliance. We can see that there is a choice for actors of either going more decentralized because it's a huge exemption, or on the contrary, trying to be fully compliant, and that's kind of splitting a little bit the choices. And also there is a lot of ambiguity. We haven't dived too much into it, but I understood that between the e-money license and MiCA, there is ambiguities for actors that are going to hold the token on behalf of someone else. Are they going to have to be a CASP? There is a lot of lines that haven't been clearly drawn, so it's bringing a bit of stress of all the other actors around it, from what I understood. So it's a welcome clarity, but probably something that's not finished forward, but yeah.
So the result of what we have seen in the last week was we have two actors now that have the MiCA license, as you know, Société Générale Forge and Circle. How is the ecosystem going to look in the future, Jon? What did MiCA bring, and is there a comment that any one of the panelists have on the general global regulation and how you see that in the future?
Yeah, so before last Sunday, a week ago, we had more or less 3 companies in Europe that were MiCA compliant. And now, since MiCA came into effect last Sunday, we have seen 2 players coming into the market, Société Générale and Circle. How is it going to change the market? Well, it remains to be seen, but obviously this is going mainstream. In the end of the day, this is a fundamental layer for DeFi to have fiat on chain. I think it's also going to, because of regulatory clarity, and people understand now that this is the future, and then we will see more mainstream adoption. The market will grow. So if you think about, it's very interesting to think about the European market or the Euro market. The Euro market or the European market has regulatory clarity, but we have non-unicorns serving this market. The US, they have no regulatory clarity, but they have 2 unicorns, and one of them is entering Europe now. So I think that's very interesting. What I think will happen is that the euro is going to pick up volume, market share, Today, euro-denominated stablecoins are only about 0.3% of the stablecoin market. It's nothing, basically. It's hardly existing. And hopefully, we will just see this market grow as it is going to be used in more and more, financial activity. And because it's a fundamental layer. When you tokenize assets like real-world assets, like stocks and bonds and so on, then you will have to exchange it for, fiat on chain. So I think we will see the euro market growing as a result of this. The US dollar market, the US dollar is the reserve currency of the world. It will always be important. This technology is global in its nature, so there will always be advantage of having the US dollar. But Europe, under MiCA and under the e-money license as well, is well equipped to basically issue e-money tokens for other currencies as well. And we know from history that Europe has served US dollars when it was not possible to do so out of US. So I would think if my friends from the US won't get their act together and bring regulatory clarity for stablecoins over there, then there's an opportunity to basically service the US dollar out of Europe.
Yeah, that's a great point, and it's a great historical analogy and one which I completely agree with. So, but I think the U.S. will get its act together as far as stablecoins are concerned. It's one of the very few things in the Congress at the moment that there's actually real bipartisan support for. And I do think there will be a stablecoin bill, a stablecoin law in the U.S. quite soon, probably next year, and that's going to change the picture again. So. Probably what's going to happen is that there's going to be a Fed-regulated stablecoin and a MiCA-regulated stablecoin, and they're not going to be the same stablecoin. So Circle's going to issue a Fed-regulated USDC and have a MiCA-regulated USDC, and they're going to be separate tokens because they're not going to want to be in a position to have two regulators supervising the same issuances. It's just too much complication from a compliance standpoint. And the historical analogy, as you said, is right there because in the bond markets in the 70s, you had the Euro-dollar bonds and you had the US dollar bonds. And for the US market, they were often the same bond issuers, but they had to do two different issuances in the two different markets so that they didn't have to comply with both sets of rules at the same time, which nobody likes to have to do. So I think you're going to see kind of a fragmentation of the two biggest markets, at least for the US dollar stablecoins, which is not going to be great and not going to be super helpful for the ecosystem generally. But I don't think I see this Fed coordinating with the EU, unfortunately.
If I can add to this, I think the competition between regulators is going to apply. So I hope at least that US regulators, Asian regulators, and European regulators, they will simply compete to provide a sensible regulation. So we will see changes going forward. And in the end of the day, it matters to have sensible regulation for stablecoins because stablecoins or e-money tokens are global in nature, and you have to basically make sure that it is competitive to other areas.
Yeah, I mean, rather than competition, I would prefer to see coordination, but that's very few and far between examples of that in any kind of TradFi industries where the financial regulators actually coordinate amongst themselves. So I don't think crypto is going to be the exception.
I think that's a very important point that you mentioned before. Are we in 5 to 10 years going to have stablecoins regulated globally and each jurisdiction having their own regulation? And that means that each issuer having a specific product for each jurisdiction that they want to be operated in if they want to be compliant.
Yeah, I mean, certainly the big markets. I mean, hopefully you'll get smaller markets like Singapore maybe or Hong Kong that allow for different types of equivalence regimes for MiCA-regulated stablecoins or Fed-regulated stablecoins. But certainly among the big markets, I suspect that there will be different regulations.
Do you have any comments on standardization, Xavier, or coordination?
No, but as you said, I think we know historically, like the financial industry is really bad at any form of coordination. Standards, in particular, and even technical standard is a difficult thing. I understand that in the end, it's a question of like the biggest actor that at some point is the de facto standard, and that works for everyone, but it's very difficult to get everyone, and especially regulators. But also it touches a lot of aspects of a particular country, so it's very difficult. For instance, from a pure legal point of view, it's very difficult to just adjust frameworks between countries in Europe. We are trying to do that for the last 50 years. And because the laws are so based on how we see what it means to have property, for instance. We don't have the same notion what it means to own something between the French system, the German system, the UK system, which is not much a concern in Europe anymore. And because of that, it's very difficult to harmonize all of this. So it makes sense that for stablecoin, it would be difficult. At the same time, we are confronted with, I think that's all the interesting reason to be in this industry. Is like we are confronted with a state where we have the technology that makes it perfectly work seamlessly. It wasn't the case before. Also, like you couldn't carry cash and easily make trade over the world so easily. There was some other friction. So now that we have this infrastructure, I'm curious about, in the long run, if it won't go in that direction. And the part I see is like public actors starting to think, okay, we may need to create some, and the main, the common standard, common infrastructures, and the main discussion of the last 2 decades was just one standard that's called ISO 20022, which is a really basic standard. It just says when you make a message between two financial institutions, what kind of high-level format it used to send a message. And it's really basic, and it took 20 years to get to a level where it's almost everywhere adopted. So I'm starting to feel like, because we have this infrastructure, it will push toward, okay, we need to add more and more layer of coordination, and parts will be harmonized a little bit the framework. But it will take really decades for sure, which is good. I will have work to do, so it's good.
And on that, it's very interesting that before the elections in the European Union, we had this idea of having a financial market union, which would actually bring, something that would be a little bit more unified financial market in the EU. But according to the results of the elections, that will most likely not happen in the next 5 years. So as you know, we had elections recently, we have a new parliament, we'll have a new commission, there's still discussing who is going to have, in a way, what function. And it's going to be very important for us to follow, at least in the EU, to see what's going to be the topics that they're going to regulate in the next 5 years. So I would like to go to the next topic, which is the real-world assets. And thinking about the financial real-world assets and thinking about the existing financial regulations that we already have globally. So, Eli, would you like to comment on, do we need specific regulation for real-world assets? Can we just use the existing ones? How is blockchain bringing something unique within, what we have done before, the business models, etc.?
Yeah, it's a great question. I mean, it's yes and it's no. I'll explain a bit, but maybe just before I start with that, since we've been talking about stablecoins, let's think a little bit about how important stablecoins are for the real-world assets protocols and the link between the stablecoins and the RWA. If you don't have stablecoins, you can't do a proper on-chain settlement of an RWA token, right? You can't do a delivery versus payment actual on-chain settlement. So there's a lot of tokenization platforms that don't use stablecoins, and they have a settlement in fiat. But that's not going to be a delivery versus payment. It's going to add a lot of risk to separate the cash leg from the securities leg of the transaction. And so that's not ideal, and that's not something that you want to work towards in the crypto space, where we're trying to make everything more efficient and reduce the risk, right? Less risk. So stablecoins are critical, and the more, if the stablecoin market starts to fragment, that's going to make things more difficult for the development of the tokenization and the RWA protocols, which I hope doesn't happen, but it's probably looking like it's going to be likely. Anyway, to talk a little bit about RWA and Centrifuge. So Centrifuge is an open source protocol. It's a horizontal model where issuers can come from any jurisdiction and issue different types of securities tokens or even non-securities offerings under a range of different jurisdictions and a range of different laws and regulatory structures. So from that standpoint, for Centrifuge, it's fairly agnostic about the regulatory structure. And the regulatory structures exist today, so we've been operating, as I said, since 2021 with our first pools. Those were asset-backed securities issued under Regulation D, Regulation S with Delaware LLCs, so a particular type of asset-backed security bond offerings, which are fairly common in the traditional financial markets. We've now got a different type of platform that's much more flexible, and we've launched investment funds, regulated investment funds that are tokenized on the platform as well, which is a different type of securities structure. And again, those structures exist today in the current regulation, so you can operate within the current regulation, but you can't really make a proper tokenization platform unless there are some changes. I mean, one of the key changes that we've been working on is using blockchain as the single source of truth. So there's a number of different types of securities that require share registries or transfer agents or share registrars, and they don't use blockchain. They can't use blockchain. The regulatory requirements and the compliance requirements that they operate under don't allow them to use the blockchain. Now, if they could use blockchain, then that could mean that the tokens themselves are the actual ownership instead of something in an Excel spreadsheet at a fund administrator's database. So it's really important that those developments continue and that the regulators adapt some of the current existing regulations to allow for the use of blockchain. Share registry is just one example, but there's a number of other types of examples where you would want a real proof of ownership. A real proof under the laws of the countries. It's not so much the regulatory laws, but the company's laws themselves, where the company's law says that the shares, the blockchain-based shares have the actual ownership. Now, there's a number of different regimes, and Liechtenstein being the first one who did that, but it's not fully adopted yet. And so until that's fully adopted, the RWA protocols are going to be of less value and less efficient than they could be.
On this, I think it's a very important thing to understand about tokenized asset is at the moment we use the general term of tokenized asset or RWA, and we are talking legally of different things. And I think it's difficult to comprehend in the crypto ecosystem because we are used to have really simple products in a sense that have a clear, like its own value in a sense, like every crypto and so on. And here, even it already exists on securities law. It's not so obvious who owns really what, and by owning a title, what do you really own in the end? And here we have two levels of question, which is by owning the token, do you really own the title? And by owning the title, what do you really have the right on? So, for instance, if it's a company, if I have this share of the company, do I really have a share, or I just have a right on the dividend? It's a different thing, and depending on the country, it's totally different, the laws, and that forces all the real-world assets companies I've looked at over the last months. I've looked at the legal documentation of many of them, and you can see that there is a lot of different montage. Like, not two projects have the same ideas, so one would create a fund that will own some of different assets, and what you own by owning the token is a share of that fund. But sometimes by owning the token, you just have the right to say that at some point you can claim the benefit from the fund, but you don't really own the share of the fund. So basically, it's different level of indirection between you and what you're supposed to really own. And at the moment, it's a bit obscure. Even I think it's missing a vocabulary that's clear to really distinguish what I'm owning by owning the token. And it's really important because then you were talking about a DVP, and if we want to build all the composability that we see in DeFi with tokenized asset, we need to clarify this different level, because then it's a question of what's the liquidity of the token versus the ultimate value. If there is a problem, can I redeem it easily and get back cash and so on? So that's totally needs to be clarified, but the problem is there is no easy way to do it because it's very different laws, very different type of assets and so on. And we just use the same technical thing that's easy to use and that's simple. So there probably will be a need of clarifying big categories so we can have a sense of the different type of risk we're having with the link between the token and the ultimate value, which is not even the asset itself.
So following the debate we had before, is code law? And what it means, in a way, I think, especially in the real-world assets, again, is it true what is on the code, or is it true on what a judge would interpret in if the case would be, brought to court? And I would say that might be more important to look at it from the legal perspective, at least later on, when we have this, clearly defined.
But just one thing on this is there is practical aspect and there is legal aspect. It's the same for securitization. If you put as collateral your house when you are having a loan, it works well if the banks knows that for sure they can easily get your house and sell it in case of a problem. So it's and we can say that code is law and actually the original meaning of this is to say if the code does something, in the end, it's going to be the way that's imposed to anyone as a first thing. So, it's going to be executed this way in the first process. And then the question is, after, is there a way to unfold all the problems that it could be? And it's obvious that in real-world assets, there will always be a secondary way of unwinding things, which will be more painful. And even this is something that at the moment hasn't touched because we haven't had enough problem yet, but we need to see how we unwind the problem of mismatch between the token ownership and the actual asset ownership and how that will be solved. And we'll need to make this process more efficient than they are currently, because if we make it more efficient when it works, but when it doesn't work, it's even more complex than it is currently, I'm not sure we're gaining a lot. And that's something that hasn't even been touched yet.
Yeah, I would say code is law until it's not. So, in the previous discussion before our panel, they talked a little bit about the Celsius and how the Celsius smart contracts operated. But you can see right now there's the bankruptcy court who's now looking at the Celsius, account holders and clawing back some of the transactions that they made on the blockchain under the bankruptcy rule. So if you make a transfer within a certain period of time prior to a bankruptcy, that can all get clawed back by the bankruptcy trustee. And they're now doing that for Celsius, where there's blockchain transactions that were confirmed under the blockchain and supposed to be, supposed to be final, but they're not final because you've got a bankruptcy court saying no. You have to look at the automatic stay, you have to look at the provisions prior to bankruptcy, and we're going to claw back all of those transactions and void them. So smart contract, yes, but there's a court who's now saying that smart contract transactions can be voided. So
in the way how regulators think, they always look into the substance and not how we name things. So they would go and say, oh, this looks legally like this type of asset. So I don't really care what you write in your white papers or in your promotional material. So it's going to be pretty interesting looking into that. We are in Brussels. We're hosting ECC this year in Brussels, and of course, Stable Summit as well. And there's been a lot of developments in the last 5 years regarding blockchain and crypto assets. There's another thing that we want to introduce you to, not only Mika, but there has been a pilot regime, which is called the DLT pilot regime, that has been finalized as well, and is now applicable. And the idea is to have a regime like a sandbox for securities on blockchain that would not be as strict as the one we have in regulated financial, in a way, regulation that does not have this specific regime. But I'll give it maybe to Xavier to start. What is the outcome of this until now?
Yeah, so basically the pilot regime really tackles the problem you mentioned of, at the moment by law, you're forced for certain type of asset to have a specific actors that holds the register, and they have to use some processes, technologies, and so on, and it's difficult to issue certain types of assets on chain because you cannot. So that's why we have this indirection, and you are creating a layer on top to allow yourself to tokenize the upper layer. The pilot regime, the idea was to alleviate some of these rules in Europe, particularly one rule that would force you for a certain type of asset to use central securities depository and to have this actor managing your assets. So far, and there has been a report a few weeks ago that showed that it hasn't picked up as much as was hoped. So it's been the challenge with all these sandbox, because once you put a lot of rules around this sandbox, you don't want to make it to remove all the regulation that existed before all of a sudden. So you need to put a lot of boundaries, and that ends up with really few actors entering the space, particularly because this regulation was mostly designed for existing actors, like banks, to be able to do it. And banks have a lot of internal processes, they have a lot of risk management and so on that make them not the best actor to do it. What's interesting is we have seen, and we're going to talk about it this week during an event on tokenization, is we have seen infrastructures like the CSD creating projects using on-chain securities without using the pilot regime. So it's a bit like the different nature find its way, right? So it's like the regulators are hoping that to attract some actors, but in the end, probably targeting the bank is the hardest because they are the actors that are the most controlled and the less prone to act. So I feel like what we are seeing positive is a real-world asset working with more a startup approach, like I think you have. And on the other side, infrastructures also looking at it because they want to prepare what everyone feels is going to be the next type of infrastructures, and they don't even need this pilot regime because they're already the ones that have the register.
I think the sandbox regimes can be very helpful, but we've seen plenty of examples where they've been mostly just useless. So it really depends on whether the regulators are going to look at the things in the sandbox and adapt the rules based on what they see and what the actors do. The Singapore sandbox prior to the Payment Services Act in 2019 and 2020, where Project Guardian originally started, was a very useful exercise. The one in Hong Kong was a complete waste of time. So, it really depends on what the regulators really think about the sandbox. Are they doing it really to learn about the process and adapt their rules? Are they really flexible enough to do that? I hope so. I mean, I certainly hope that if there could be a securities token regime in the EU, which is different than the regular securities laws regime, that would be a fantastic development, obviously.
I think one comment that projects usually had, mostly bigger institutions, where we are not sure if this sandbox is going to last for longer than 3 years. So we got a letter from the former commissioner alluding to the fact that it might stay in practice in longer than 3 years, so that might be a good sign, but still there are other problems that we have with it for sure. For the last set of questions, I think I would really like your opinions on a little bit more of a general, assessment, bad and good things about the whole, kind of connection between stablecoins, potential CBDCs, potentially a digital euro, real-world assets. What kind of revolution is happening, and how are you going to be a part of it?
Yeah, I think in general, I think it's important for regulators to maintain the basic rule that has been guiding EU policy for a long time, which is basically saying that if you have the same activity, same risk, you should have the same regulation. That's very important. We are seeing very interesting development under MiCA. There is a very interesting development in Europe for real-world assets. We are supporting a lot of those projects in Europe, really interesting. But in the end of the day, I think it's just important to maintain this basic principle. You don't need to invent new regulations for everything, even if you have new technology. Just like the e-money legislation is more than 20 years old. It was supposed to be technically neutral, and that is important. Then you have to basically make sure that your technology is supporting the law. That is important. Now, going forward, You mentioned CBDC. That is not the topic of this, however. But I think for that, for CBDC, the digital euro, which is the European Central Bank saying basically, well, we're going to issue a retail CBDC. I think that's really interesting. For me, as a co-founder of a company in Europe, which is issuing, issued the first digital euro on chain, I think it's really interesting that we have a central bank saying, well, we're going to issue a digital euro, we're going to regulate you, we're going to compete with you, and we're going to oversee your functionality. So I think, I think it's important for the sector, the participant, to have a very honest debate and discussions with the regulators, policymakers, central bankers, and so on, because this is new to many of us. But in the end of the day, I think it's really important to have the end goal in mind, which is basically, what is the purpose of this? It's basically trying to make, finance in this case more efficient, make it better, and more, fair. So I'm optimistic. It has been a pleasure to speak to policymakers in Brussels. They are willing to listen. They're willing to basically change things that, you say, well, I don't think this is working, and they listen. And that's a good thing. I think that's more than we see in some other jurisdictions.
Yes, yeah, absolutely. That's true. I mean, I think we're really just at the very beginning of this process. I mean, MiCA implementation is just starting now. There'll be a MiCA 2.0 at some point. We don't really know how the NCAs are going to enforce MiCA, how the implementation is going to go exactly. The US is even further behind, so you've got the two biggest markets really just starting on the path of regulatory change. And I think the market's going to look very, very different. The other thing about regulation is that there's often a lot of unintended consequences attached to it, so very difficult to predict. There's often a lot of regulatory arbitrage opportunities that will be out there, also very difficult to predict. So, I mean, our view at Centrifuge is really to develop something that's as flexible as possible. An open source protocol with a lot of different opportunities, because we don't really know where the market's going to go. We would love to know where it's going to go, but we certainly don't. So we've tried to build a platform with a lot of flexibility to cater for whatever is coming up in terms of the needs from the market from a tokenization standpoint, and whatever can be done from a regulatory standpoint.
To me, the thing that I'm always advising is the question of being a bit more strategic and intentional with regulation. I think the problem we have in Europe is we have a lot of culture, history of how we regulate, and we have, I feel like, good students that try to do the right copy of what should be a good regulation in this topic, and I think that's what's slowly not to the advantage of Europe. I've been working with a lot of emerging and developing countries, and I can tell you that there is a range of countries that are already reasonably grown. They don't have all the legacy infrastructure problems, so they don't have all the weight of having big actors like the CSD we mentioned, all those things. They don't have the big bank sector that's lobbying too much. And if you have sharp people in charge of regulation that say, okay, how we make our place a good financial system and use the right infrastructure to make easy payment internally, easy cross-border payments, which is a nightmare in many countries, attract capital so people invest in our countries, and even become a financial hub for some. Not everyone is in a situation of doing that, but you mentioned Hong Kong or this kind of country that have a history of trying to be this kind of hubs. These ones are really taking a leapfrog, and I think it will be painful for some other region to not have done those steps. And you can see that they're very sharp people in charge, and you don't need much. Like for other industries, it's really hard to bootstrap something. Like here, it's just a question of taking the right decision, and you can attract a lot of ideas. You need also to be aware of predatory practice, because you had a lot of crypto projects that have a lot of capital and that are going in the emerging country and say, oh, we're going to issue a stablecoin for you on our blockchain. Oh, don't worry, the fees we're going to cover at the beginning, but then you will have to pay the fees with our platform. And it's really this kind of weird thing that they just solidify some sort of walled garden. But I think everyone in the world see a long-term vision of a more interconnected, a more interoperable, a more easy way to do finance. The long-term vision, everyone sees it. but on the road, I feel like some countries will take an advantage, I mean, relatively, by being a bit sharper on what needs to be done, because it's not difficult. It's just a question of, as you say, opening a little bit, giving flexibility, because no one knows exactly what happens. CBDC is an option, and I think I've been working a lot on CBDC. I think they have an interest, but probably, for instance, in Europe, we have an overwhelming project that tries to do everything at once. That I have some skepticism on this, but it's an option also. But it's a question of like being strategic of what needs the economy to grow and what are the right infrastructures and decisions.
1 minute to go, one question for each, so 30 seconds. Are we able to escape regulation, and how? Through decentralization or how?
No, I think it's, like when you board the plane and you are going to the US, you want to make sure it's safe. I think the same thing goes with your funds, I don't think we escape regulation. I think there has always been regulation making sure that you have, consumer safety and all of that. No, not in my mind.
I mean, I think there's always going to be part of the crypto market that escapes regulation. I think that's part of the ethos of the crypto space. It's not going to be real world assets for sure, but there will be some other parts of the crypto market that will, smaller and smaller parts, I believe, that will always manage to find a way to evade any kind of regulatory space.
So on this, I'm really happy to see that a few years ago, I thought that we would have a split and have a more permission DeFi. You remember there were a few projects trying to create this really, and I'm happy to see that we have a spectrum. I don't think that the illegal crypto will be so small, and I'm happy to see it still working, because also it's kind of itch that pushes everyone a bit, sometimes on more financial aspects, sometimes on privacy. I like that exists, and I think that's necessary. But I think that a lot will be more compliant with the spectrum, like different aspects. And I'm happy to see this rich ecosystem growing together.
Thank you, panelists. Thank you for all of you to stay until the end. And yeah, we'll go next.